Firstly, I want to revisit a chart that I love. This is based on Goldman Sachs' overweight and underweight mutual fund picks. The blue line is looking at the top 50 stocks in the S&P 500 and mutual funds that are overweighted, so they're extra long, those stocks relative to the benchmark index. White is the ones that they're underweight. What you want to see, obviously, is that spread widening out. In the bottom panel here in the yellow, that is indeed what we're seeing. One of the highest ratios for outperformance of those heavily weighted stocks, going all the way back to way beyond this chart. Earlier, this is basically going to be one of the best years since 2009 for active managers. Here's a few other reasons why. Let's take it over this chart. Momentum. This is a big factor play. I think one of the best ways to look at markets right now, thinking about sectors, thinking about overweight, but also thinking about the factors and watching those flows. Look at the bottom panel here. This is showing you the flows into the MTUM factor-based momentum chasing strategy. This is basically an ETF you can look at that chases the top performing stocks over a certain period of time. Green bars down here, inflows, the highest in some time earlier this summer in late June. Investors saying, look, we think what's been winning throughout this year is going to continue to win. Even though we've had a couple rocky days here in the past couple weeks, these are stocks that have continued to hold on pretty well. You can see we're off the highs, but guess what? The high's not very far away. It's about a couple weeks ago. Those investors that were chasing the companies that did well, this has been a strategy that's paying off. And that's a big move because before this, momentum kind of had some rocky periods throughout 2015, 2016, didn't quite work. Finally, we talked about the long investors. What about the short investors? If you look at short interest, this is the white line. This is just all exchange reported average short interest on the S&P 500. This is 3.9% right now. You can see this plateau, one of the highest in a couple of years. 2016 and 2015, we had real high short interest. We're not at those levels, but we did see this tick up throughout the year where investors kept getting more short. And then, of course, we want to find out what exactly those shorts have done. They've been holding on to them for quite a while, even though the short stocks, as measured by this index in the blue, have gone up. But if you look, since we've had some volatility the past couple weeks, guys, these stocks have indeed led the market on the downside. So the shorts are actually doing pretty well, and that they picked the right shorts, and the longs are doing pretty solidly because they picked the right longs. The takeaway here, guys, is that I think some dispersion within the market and volatility that's crept up has made it somewhat of a market that's a little bit more amenable to going in, picking companies, finding the ones that you think are going to do well for the right reasons.
Which is amazing because stock pickers will always say it's a stock picker's market, right, no matter what kind of market it is.
This is true.
So in this case, maybe it actually is.
Maybe it actually is, but you got to remember there's some other things going on. There's a good bit of breadth within the market, so you don't have to necessarily always get the right ones. We talk about the FANG stocks leading the market, and yes, by market cap weight, they are driving a good bit of the gains, but there's a lot of companies right behind them that are doing well too.
It's quite interesting because we've talked about the fact that the markets went nowhere during the earnings season.
Yep.
I mean, 0.2%, wasn't it, overall rally for the S&P 500. What about for the next couple of months as we push towards the next earnings season?
I like that you bring up earnings because earnings are usually a pretty reliable time in which you can look at the market and assume that companies are going to do well because companies typically do well in earnings. That's just because of the way estimates work. However, at these valuations, earnings season is not exactly a given in which stocks are going to do well. You really had to hit all the bottom line. You had to hit the top line to get any kind of stock appreciation, and I think that kind of casts some dubiousness on the next earnings season.